Today, folks, we're going to talk about three of my favorite REITs, these real estate investment trusts for those of you looking for those monthly distributions, that wonderful passive income. And I want to talk about them because we're heading into a REIT earnings cycle. And in this interest raising environment, there are some tailwinds these companies have to deal with that I want to talk about. So we're going to point out the great, the bad, the ugly, everything that you're going to need to know. Some of these are US REITs, some are Canadian REITs. We'll talk about variable rate mortgages, the real estate in my area, and so much more. If that's a conversation you think you'd appreciate, hit that like button, folks, because I want to point out a fun little tidbited fact. And for those of you that didn't know, Berkshire Hathaway, one of the 10 largest companies in the US held by Warren Buffett, actually had some exposure to a real estate investment trust, and that was Corp, at which they've completely liquidated out of it in their last filings. And a lot of people think that the REIT market isn't exactly a core place of competency for Warren Buffett, so maybe he took that money, dumped it into TSM and some of these other stocks he's recently been buying, and it led to some concern, some things that I noticed. And honestly, I think the reason he sold it isn't for what you think, because we can see that this company bumped up pretty dramatically in the latter half of 2022. It jumped 20% and has flatlined ever since. Why is that? Well, because Store Capital is getting bought out. It's going to be taken completely private, and they're just going to give you all your money back for your shares. So that's probably why Warren Buffett just jumped the gun early and got out, because apparently in Q1 of this year, this thing's going private, baby. But let's talk about the variable rate market real quick here in Canada. The Bank of Canada is saying that the trigger rate is starting to get hit on variable rate mortgages, which I think account for about 13% of the outstanding mortgages in our market. But we can see that the principal plus the interest being paid has really crossed a line here where the interest is now well above the principal and interest most people were used to paying. And this is why I'm telling you, if you have a war chest, some capital, in the next year is going to be prime time to start buying real estate. In fact, I'm considering doing that because in my area, Richmond Hill, we got the GTA, the greater Toronto area. For you, if you're like a millennial like me, you're probably not looking at a house because they cost millions of dollars. But when it comes to the condo market, we're seeing some pretty good corrections. I mean, condos that were selling for over 800,000 are now down to the 6s and 7s. And just take a look at this, because Richmond Hill is a pretty high valued area. There's some new builds here that are selling for $765,000 for 2-bed, 3-bath. Like, this was pretty unheard of a year ago. So if this keeps correcting, it's going to be great for you and me who are looking to buy. It's not going to be so great for some of these REITs we're going to talk about. And I'd like to just say a thank you to my Patreon members. I recently just posted a video on what we can learn from the 1980s Toronto real estate crash, where we reviewed videos and interviews from that era that's so reminiscent to today. And if I decide to buy real estate, I'm only really going to talk about it here. It's $5 a month. It's less than a Starbucks coffee. I think I'm offering 10x the value, and I talk about my personal finances and stuff I'd never reveal on my YouTube channel, unsponsored and unsolicited. But let's get back to it. But let's kick it off with like one of the best performing REITs in the US over the last 10 years, and that has got to be Stag Industrial, which still in the last year is down about 16%, but has rallied really well off of its lows. Pays about a 4% yield. PE looks a little bit high, but I don't trust PE ratios on REITs. But when you take a look at this, guys, is this a buying opportunity? Well, this is one of my favorite REITs I used to have exposure to, but right now I don't. And that's not because I don't like it, obviously just shuffling stocks around. But the reason I love this is when you take a look at the total assets, sit at $6.1 billion, and their total liability is only 2.7 roughly. They have a really great debt to asset ratio. And this is a company with tenants like Amazon, like a lot of the auto companies. It's just a shipping and warehousing based industry. And there's some fears with their growth moving forward, because obviously they were going through a massive acquisition phase, and I think that's going to start to slow down. So we might not see the same growth out of this REIT. But when we're talking about stability, man, this company's done a good job managing their debt. What you really want to look at with all these REITs is the debt maturity. And when we take a look at this coming through 2023, only $103 million of their outstanding of that, $2 billion in debt is going to come due in 2023. And currently the weighted average interest rate on it is around 4%. And we can see most of their interest rates sit between 4 and 5%. And a lot of them aren't coming to maturity for some years to come. This is why you want fixed rates. With fixed rates, you're not getting the best deal on the interest rate, but you're not dealing with the volatility of the market. And I love resilient REITs because the management really proves why this matters in markets like this. So this is a company where I think the rates will drop off long before these things come up for renewal, because like one of their biggest renewal rates comes up in 2026, and that's some of their lowest interest rates at like 2.59%. And you can see just from the balance sheet discipline here, like 94.5% of their interest rates are fixed. Like, this is a wonderful looking balance sheet for for a REIT, but I do expect Stag to see some slowdown in the earnings growth. But again, we're going to see some stability, at least in this environment, for a little while until things cool off, right? But taking a look at Slate Grocery REIT, and I'm trying to give you a skew of REITs. We're talking about Stag, Slate, and then we're going to take a look at Canadian REITs like Riocan and CAPREIT, some of my two favorite Canadian REITs. Slate Grocery is more of a US REIT that does trade on the Canadian markets, that has proved to be incredibly resilient with about a 7% dividend yield. And just taking a look at their total assets, sitting about 2.3 billion at a debt of 1.175 billion. It's not nearly as resilient as something like Stag with about a 50% debt to asset ratio, meaning this company could see some hindrance from the interest raising environment. So you really want to pay close attention, guys, to when their debt and mortgages come due. And we can see a look at their revolving debt, their term loans, and their mortgages. And we can see a lot of these aren't really coming due till 2024, 2025, with some of the largest debt in 2025. And we can see their effective rate right now is pretty much average across the board, about 4.22%. This, again, why we love these fixed rates. These REITs will be able to glide through this. And I think Slate Grocery REITs actually going to probably be a little bit more stable in the stock price than something like a Stag, because this one isn't really much of a growth REIT. As much of it is just kind of a place of stability for dividends. It pays a way higher yield at over 7%. So if you're just looking for income, I would pay really close attention to this and perhaps wait before buying more and just see what the earnings look like coming out of this last quarter, and just be patient with these. That's what I'm doing, but I think there's some good buying opportunities here. Take a look at something like Riocan. This one I do have some concerns over. We have exposure to it still with my fiance, but this thing has been rallying back lovingly off its lows. It's up like 26%. It's paying 4.41%. You might recall we were buying this really aggressively during the pandemic period. What a buying opportunity this was. I think my fiance still holds her original shares from those times. Total assets at about 15.3 billion, which is insane. That's so much real estate value, and total debt sits at about 6.8 billion. So we're seeing about a 45% debt to asset ratio here. And again, taking a look at the debt maturity, this one's got a lot coming up over the next couple years. I mean, in 2023, it looks like they're expecting almost $1 billion to come into maturity. Through 2024, roughly another billion. And their average interest rate has been around 3.3%, and it has been increasing over last year, and it's something that I'm expecting to continue seeing. Now, this company really cut their dividend back. They're in a place of resiliency to ride through this, but my biggest concern is if Toronto real estate corrects a lot, and same with all of these REITs. As real estate corrects, what we're going to see is these REITs writing down the losses of that property value against their income. So it'll make the EPS look really bad, but I promise you it's probably not that bad. So we're trying to find REITs that have very stable tenants. Riocan has large exposure primarily to malls, but they have tenants like the banks, like Walmart, Sobeys, grocery stores, very stabilized tenants. And because there's no new malls going up in Toronto, they kind of have a monopoly over that. So I think they're going to be just fine. But my biggest concern is their development. Riocan has a lot of development coming up in their pipeline, and if they're selling it through the next year or two, they might be selling it at reduced rates. And usually with companies like Smart Centers and Riocan that are doing these massive amounts of development, that could very hinder their future sales growth, and it could actually hit some of their bottom line, because you do see those sales resembled in some of their earnings. So that's something I'm going to be paying attention to as well. And I'd also want to take a look at some of the apartment property REITs like CAPREIT here, which actually got hit pretty hard. I mean, it was one of the hardest hit REITs, and we can see that it's rallied back 25% as well. And this one has a little bit more dividend growth compared to some of the other ones we looked at. You know, it's only paying a 2.91% dividend, but this company also, man, their conservative debt metrics are astounding. You can kind of just take a look at total debt to gross book value. So debt to asset ratio is only at 39.4%, so even better than that of Riocan's. But again, just taking a look at the maturity of that debt, no more than 15% comes due in any given year, and that's not till 2032 plus. So we can see that a lot of their debt these are like 10-year plus fixed mortgages. So we can see coming into 2023, only 7% are coming due, 8% in 2024. So this company, I don't expect to see a wild amount of growth out of, but considering, you know, we saw a really big increase in the rental market, and rental prices are starting to come down again along with real estate prices. So this is going to nominalize. But I think if you're just looking for stabilized cash flow, perhaps you're in a place of retirement, these REITs could be a great place to park, even in this interest raising, you know, recessionary type environment. And again, if we see them get hit any further, you know, I might have to really start buying them back, but I just keep an eye on them for right now. And at some point they will make their way back into my portfolio. But I'd love to know what you think about this in that comment section below, and what your favorite REITs are.